Hi, I'm Adam Carlini. With me is my partner, Grant Haddon. We are Dynamic Wealth Management. Gary's behind the camera today, and this is our update on the markets for Dynamic Wealth Management. It's been a while since we've done one, and there's a lot of news lately. We're here at the end of the summer, July 31, and so there's a lot for us to cover.
Yeah, 2019 has been a volatile year. There were some real bumpy times back in January and then back at the beginning of June as well. So since then, the market's been trending pretty well for us, but definitely some news to talk about. So we'll jump in the charts and show you what we're talking about.
All right, so this is our update for July 31st, 2019. And just before we get going, just want to let you know we have no upcoming events. We're on our summer break. We'll start back up with our investments for breakfast in late September, early October. We'll let you know when we do. So what's the big news for the economy? I'll tell you in just a moment. First, just to let you know that despite what happened today, our risk indicator has not changed. We're still in bullish territory. That means that there might be a correction here, but not enough to change our mind about the direction of things. So we are bullish with our core ETF model. Grant will talk more about that. So our key event today, something happened today that has not happened in this decade, the decade of 2010, and that is interest rates were cut today by the Federal Reserve. So it had been announced, and Jerome Powell, the head of the Federal Reserve, went ahead and announced today that the rates would indeed be cut. President Trump's been pushing hard for 50 basis points. A lot of people on Wall Street probably expected 50 basis points. I think the market was expecting 50 basis points, or maybe some indicator that there'd be maybe another rate cut. When it didn't get that, we actually had a market sell-off, which is interesting because normally on the day of an interest rate cut, when you cut 25 basis points, the market rallies a little bit. And then it typically also is up 3 months out and 6 months out and a year out. The market is higher normally on an interest rate cut of 25 basis points. So why did it sell off today? Most likely because it was already baked in that the market was going to get an interest rate cut, and then it wasn't what the type of cut they were expecting. So back in May, the market had a terrible month. It was down big. And then they began talking about cutting rates, and that got the market excited, and it rallied right back up, took away all the losses of May, and moved on to marginally higher highs. And again, today, the market didn't get exactly what it wanted. And here in this report here from MarketWatch, I'll tell you what the big deal was. You see that comment right there? Mid-cycle adjustment to policy. That's the main thing the market didn't like. So despite it being only a 25 basis point cut. So why? What is this mid-cycle adjustment to policy? First of all, the Federal Reserve has cut interest rates an average of 23 times a decade, going back to the 1960s. And this is the first time this decade, and we're only a year done, a year from now, this decade's over. And this is the first time we've cut rates. So why did they cut rates? Especially when you consider this, more than 92% of all rate cuts since 1960 have come from higher levels than we are right now. And almost all of them, 99%, have come when unemployment was higher. Right now, we're at like the lowest unemployment, at least by the way the government measures it, in 50 years. So that begs the question, why cut interest rates? And so Federal Reserve Chair Powell clarified that it was because of this mid-cycle adjustment to policy. And so he then went on to explain, once the market tanked from that, he tried to bring things back up a bit, and he said, look, I'm not saying that this is a one-and-done thing. It's possible that there could be more rate cuts. I'm also not saying that it's the beginning of a long series of rate cuts. Now, that's a positive statement. In other words, he's saying the economy is strong. This is really done to appease our president and to help with our battle with China on trade policy. President Trump has been pushing for a cut in interest rates, not because of a weak economy, but because in his battle with China, it is hurting corporate profits. And the market's been able to stay afloat after the big drop in May with the hope of lower interest rates that would make things a little more competitive. But now that we're there and the cut wasn't as much as they were expecting, the market didn't like that, and we got a bit of a sell-off. So again, why do we want to cut rates here? Chairman Powell said it was insurance. Effectively, with our battle with China, it's going to hurt the market. It has been hurting the markets, as I said, and the market just was only able to recuperate because of the expectation of lower interest rates. And then there was the Federal Reserve would help things out. Why does Trump want that? Because he wants to win this trade battle with China, which is a good thing. I don't know that it's winnable. We'll see. But in order for him to be reelected, he needs for his big talking point, which has been the economy and the stock market, to stay good. And he can't keep fighting China in this standoff and keep a good market and economy without some help. And so that's the Federal Reserve is actually doing something that's outside of their normal mandate. Their normal mandate is max employment, stable prices, and moderately long-term interest rates. Stabilizing the stock market so a president can get reelected is not part of their mandate. So we're in uncharted waters here. This is a strange thing. So anyway, looking ahead, you can see on this chart that normally the Federal Reserve starts cutting rates and they do it a lot. Well, that's not necessarily good. That helps the economy and the market to pick back up, and that you would do when you have a weakening economy to try and to spur the economy. And then the economy gets overheated and they raise rates and then they do it all over again. Well, we went all this period here with rates flat, nothing going on, zero rates basically, until we began this rate increase cycle. And then the market was expecting something like this, where we'd cut rates a bit, not too long, but this is what they got. It was more shallow, and that's why the market responded, I think, the way it did today. What does this mean going forward? The Federal Reserve is saying that they think rates, the GDP is going to be slowing slightly. So they could still cut rates a few more times. It's going to be data dependent. So will they cut again? We'll see. It's data dependent. Unemployment might rise a little bit. Inflation should rise a little bit, but it should stay within parameters. So there's no need for this big regime of cuts here. This smaller one ought to do the trick, and then if things are weaker, we can cut again. All of that, I think, is generally good for the market longer term. It just got ahead of itself, and so we probably get a little bit of a sell-off. Maybe it goes a bit longer. We'll see. It did pull back today to the most recent breakout point, which is a logical point. Maybe it gives back some more from here. Maybe it rallies. We'll see, but we don't expect it to turn into a bear market or recession here, and our indicators are not telling us that in the intermediate and longer term that this market's going to head south. And so for now, we continue to be in the bullish camp. With that, I'll turn it over to Grant to give you more information.
All right. Well, Adam did a great job walking us through the economy and giving us an update there. I want to give us a quick update on the actual charts and what we see going on out there. So here is the major financial markets for the last 9 months. So you'll notice what's on top over the last 9 months. Well, it's stocks. Stocks are up about 12% over the last 9 months. And you'll notice they had that big drop down into the end of 2018. And really 2019 has been pretty good, except for a couple bumps right here in May and into, well, really it was for the month of May that it was really another bump that we had there. But stocks have done well. Bonds actually have done well over the last 9 months, which is surprising. But the dollar has been kind of floating around sideways, and commodities are negative and have been negative for a really long time. We've avoided commodities in our models. Here is the S&P 500. What we're looking at is the all-time high. So we hit an all-time high just recently, about a week ago. Well, yeah, just about, and we're coming down off this just a little bit, but I think as it's been already pointed out earlier in the video, most people are viewing this as a short-term buying opportunity, not as the beginning of a big drop like we've had. Here is the Dow. Similar situation. We had an all-time high a little farther back, a couple weeks back, but still it was real recent on the all-time high and just had this recent drop. The NASDAQ, similar story, about a week back. We hit all-time highs. The Russell 2000 small caps is the only one that is far away from its all-time highs. To find the all-time highs in small caps, you got to go all the way back to September. So the strength from September till now has definitely been in the larger cap stocks, which is where we focused most of our portfolios as well. We have very little exposure to small caps. Here is the sectors, the asset classes over the last 3 months. So the S&P 500 up about 2.4% over the last 3 months. Dow right there close, NASDAQ a little worse, small caps a little worse. International emerging markets is down 3.5%. Again, if we're looking for something that's underperforming, it's international. We don't hold any international in our portfolios, and we haven't for years, as the U.S. has pretty consistently outperformed. Dollars up a bit. Commodities, again, as we pointed out, are down. REITs and real estate doing well. Treasuries actually doing well over the last 3 months as well. So here are the sectors. Just to point out a couple highlights here. So consumer staples has done really well. Real estate has done really well. Healthcare has done pretty well. Financials has done pretty well. Materials done pretty well. Tech. So the only thing is energy. Energy's been down. You'll notice when we go into the following slides here, we'll show you what we're holding in our sector rotation model. And a few of the holdings are definitely real estate, materials, and staples. Here's our model allocations. We're in the green zone, as was previously pointed out, which means if you're a growth client, you're 100% in. If you're a moderate client, you're 80% in, 20% defensive. If you're a conservative client, you're 60% in. And this is as aggressive as we'll get in our core ETF models. For our sector rotation model, I promised you I'd point out what we're holding currently. The consumer discretionary, industrials, home builders, consumer staples, financial, real estate, healthcare, and gold. Actually, our gold position's up about 10%. It's moved a lot recently. These are the other sectors that are in our universe, ones that we could pick up. Remember, we rank these 1 through 17. And then we take the top 8, the best performing recent 8. So that's how we got to these ones that we have now. We rank them based on performance and volatility as well. And our 8 holdings are doing pretty well. They're the top performers in the market right now. So we're really happy with our models across the board. Thank you so much for tuning in for this video. We'll do another video soon. And please reach out to us anytime you have any questions. Thank you so much. You guys have a great day. Bye-bye.